Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, stock futures pushing higher amid a sigh of relief for investors following that February CPI report. The inflation data coming in cooler than expected for last month. The report is a welcome sign for economists who warned the print could be at risk of seasonal adjustments to the upside. Meantime, the president downplaying concerns of a recession when speaking to reporters.
Do you think there will be a recession?
I don't see it at all.
Plus, President Donald Trump's 25% tariffs on steel and aluminum imports going into effect today. The levies have already been met with an immediate response from the EU, the European Union, which plans to impose duties on up to 26 billion euros worth of American goods. The EU will target politically sensitive goods, including soybeans from Louisiana, according to a senior EU official. Other affected countries, including the UK, refrained from immediate action and called for negotiations.
And amid the market sell-off, Goldman Sachs cutting its S&P 500 forecast for the year to 6,200, down from 6,500, indicating an 11% potential move to the downside from current levels. Actually, move to the upside from current levels. The bank said the revised estimates reflect a reduced GDP growth forecast, a higher assumed tariff rate, and higher levels of uncertainty. Strategists went on to say the cohort of Magnificent 7 stocks that have driven markets for years have now become the Maleficent 7, the S&P 500 index.
U.S. stock futures pushing higher this morning. This is following the better than expected inflation report. A big sigh of relief for investors out there, but worth noting that we're off of some of the biggest move higher that we had seen earlier. The Dow still holding on to positive territory by about 0.7%. S&P 500 futures up by about 1.2%, and the Nasdaq Composite Tech Heavy Average up by about 1.7%. But just breaking down some of the elements within this report, worth calling out once again, the indexes here. Shelter still the primary leader. Airline fares, that was a surprise shock to the downside, moved lower by about 4% for that index. And then for all of you who are trying to figure out, all right, this dang food prices that we're trying to navigate right now, well, that ultimately for the index for food away from home, that increased 0.4%. The index for food overall increased in February, rose by about 0.2%. Food at home, though, unchanged.
It's really bemusing to look at the moves to the upside in markets this morning, particularly when you consider the fact that a lot of the movement to the upside in this inflation print, think your airline fares, in particular transportation, that is indicative of consumer weakness, and consumer weakness would be negative for the stock market. So maybe investors are thinking that inflation is coming off its highs. Maybe there's room for the Fed to become a little bit more dovish, and that's why we're seeing this rally to the upside. But at least Cameron Kreis, one of my favorite macro strategists, he's calling out this morning that he wouldn't be surprised if we stop this move to the upside in equities off the back of the CPI print once investors digest the fact that there is a sign of consumer weakness in this print, which again would be a negative signal for equities.
Yeah, no, absolutely. And so one of the things that, oh, by the way, for anybody who was wondering if I was going to say anything about the eggs, yeah, that was up 10.4%. So you got that. You can check that off your bingo card. But at the end of the day, it's going to come back to some of the categories that we were discussing with our panel of economists and some of the market strategists this morning, just with regard to where we could see in future readings some of the tariff policy start to show up in indexes here. And most notably, the targeting that's taking place that we were just mentioning at the top of the show. I think that's what is really going to catch consumers when it's hitting the pantry, when it's hitting in the refrigerator, and when it's potentially hitting some of the utility costs that they pay for. Oh, yeah, by the way, cars too. And that's whether or not you're buying a new car or if you're just servicing a car that you currently own and you're looking to get a part, that might cost you a little bit more too.
Yeah, seeing a lot of those cost increases under the hood as well. Well, the stock market has been on the brink of correction amid the market sell-off. Our next guest says the market is in the ballpark of a bounce, and we're certainly seeing that playing out this morning. Joining us now with more, Keith Lerner, Truist's Co-Chief Investment Officer and Chief Market Strategist. Keith, always a pleasure to speak with you. So walk me through the market reaction that we are seeing, a huge lift to the upside off the back of this slightly softer than expected inflation print. Does the market think that today's inflation numbers mean that the Fed can be more dovish?
Yeah. Well, Madison, Brad, always great to be with you all. Maybe if I zoom out for a second before I go directly to your question, we downgraded stocks in late February, closer to all-time highs, because we thought the risk reward was changing. And then yesterday, when the market was down about 600 points, we were down almost 10%. And we put out a note yesterday that the market was getting stretched to the downside, at least on a short-term basis. So I really think what happened this morning is this market on a short-term basis has moved down a lot. And you were vulnerable to good news. And you got that in the CPI side. I don't know that this changes the intermediate equation. I mean, the Fed is still likely not to cut rates till May or June. And part of why they need to cut rates is because we're seeing some softening in the economy. So I just think you're oversold. The CPI report came in a little bit softer. It gives a little bit of a reprieve. And I think this reprieve likely has further to go. I just think in the broader scheme that you're going to be more in a choppier market. And as you get back, if you get back anywhere closer to, say, 5,800 to 6,000 on the S&P, I think there's a decent amount of selling pressure that you'll see.
And so with that in mind, how does that kind of influence what we have discussed and heard from some portfolio managers and investment strategists out there that have really looked at this as the great rotation, and that rotation pushing people back into some of these safe havens in the market?
Yeah, well, I think time frames really matter. On a short-term basis, I think what you'll likely see is a rotation out of some of those defensive areas and probably into some of the areas that are hit the hardest. So like this morning, you're seeing small caps up, you're seeing technology get a bid. So I think that reprieve has some further to go. But again, from our perspective, the way we're thinking about it is the risk reward from a more of an intermediate standpoint is still more mixed. We were very bullish over the last year that we changed our tune in February. So I would just say the way I would think about this is if you're in some of these more speculative areas and we get a bounce over the next week or few weeks, if you're over your skis on risk relative to where your long-term targets on, we would use that as an opportunity to lighten up somewhat, as opposed to saying, hey, we're going back to new highs. We don't think that's most likely in the cards right now.
How are you thinking about and answering questions to clients about when to get back in, when we might be at a bottom that is just too cheap to ignore in this market?
Yeah, well, one thing I was to say, we don't really look at it as, green light, red light. For us, I mean, we are anchored to long-term portfolios, and a lot of your viewers, they have goals beyond the next month or two for their money. So, I mean, when we make changes, it's basically relative to these long-term targets. So we think, especially if even though we've kind of dialed down risk, we still think, an allocation towards equities makes sense. I think the question is maybe more, when would we go back and say, hey, we downgraded equities more towards benchmark ratings? When does it make sense to say, hey, it's more risk on, and we think this is a good opportunity? And I would say, I think there's a couple components. One, we've had a nice correction in price. There's also a time component that typically when you have a corrective period, it takes, several weeks to several months to kind of work through. I think we also need to get through these next couple of months and actually closer to the next earnings cycle as well. So I think maybe a little bit lower prices and actually, giving it some time to digest and getting through some of the more challenging aspects of the current administration's policies. I think there is a setup that later this year that the market, instead of focusing on all the perceived negative as far as tariffs, you may start to focus more on tax extensions and deregulation later in the year. But again, I just think that there's a kind of a time element that we're still going to be waiting. And I can't pinpoint that exact time. We'll know it when we see it. We're just not there yet.
In a clip that we played to start off the show, Keith, you heard the president saying that he doesn't see a recession. Is there something that the president is ignoring with regard to the implications and the ramifications, I should say, from some of the tariff policy and the tit for tat that's now playing out as some of these tariffs go into action, whether that be targeted towards Canada, Mexico, whether that be targeted towards the EU, whether that be targeted towards China? We've kind of, picked every different area of the world to go after fairer trade deals. But in the interim, it seems like the market is trying to best get its head around what a recession might look like.
Yeah, it's interesting. So I would just say upfront, our base case is not a recession, but there is some softening in the data. I think one of the challenges that the market has had this year is that after a lot of economists have been focused on recession so much the prior 2 years, you came into 2023, 2024 with very low expectations for the economy. the economy easily surpassed. This year, the bar was raised at a time of growing uncertainty now. So you're basically seeing economic surprises to the downside relative to elevated expectations. I do think there is some risk with the tariffs. You're seeing that in some of the recent earnings. You're seeing that in the economic surprise index as well. So, but I think in general, that's part of the reason why we're seeing a bit of this soft patch. Again, at this point, I think it's premature to say that it's recessionary. We also have to remember that our companies have been battle tested through pandemic, inflation, fast rate hikes. So I just think the risk is that more of a slowdown relative to these higher expectations, and that's why the market had been selling off prior to today's kind of bounce.
And your latest note sort of purports this idea of using any bounce back to dial back risk. Where can investors find that safe edge in this market? Where are the areas that they can kind of hide out while this policy uncertainty unfolds over the next first half of this year or potentially longer?
Well, I think one of the main areas is, again, if you have a 50-50 portfolio and you were at 60% and your real target's closer to 50, I'd be closer to 50, number one. The other area is, plain old boring cash. I mean, cash is still earning, a decent amount, and it provides flexibility and optionality as we have different disruptions during the year. I mean, we still would focus on large caps, followed by mid caps. We're less favorable on small caps, even though I recognize short-term small caps may have more of a bounce here short-term because they're down 15%. And then on the fixed income side, we're still focused on high quality. We've been bulls on gold over the last year. Again, moderate positions as well. So my message isn't one of like, hey, the end of the world is happening, that you should just totally change your portfolios. It's just on the margin, dialing down and having some flexibility with a little bit of cash as we have, potential some disruptions along the way to take advantage of opportunities that will likely present themselves during this year.
Keith, thanks so much for taking the time here with us this morning. Really appreciate it.
Yeah, great to be with you.
The EU Wednesday announced retaliatory duties impacting $28 billion in U.S. goods. The measures unveiled just hours after the U.S.'s 25% tariffs on all steel and aluminum imports went into effect. President Trump defended his tariff policies in a meeting with business leaders Tuesday afternoon.
The tariffs are having a tremendously positive impact. They will have, and they are having. And ultimately, the biggest win is not the tariff. That's a big win. That's a lot of money. But the biggest win is if they move into our country and produce jobs. That's a bigger win than the tariffs themselves.
With us now to discuss, we've got Rob Casey, Signum Global Advisors partner and senior analyst here. Rob, just want to go back to what we just heard in that clip here. What is the overall kind of relationship and the reaction that we're seeing between Trump's defense of tariffs versus what CEOs are navigating right now?
Yeah, well, I think you just heard it from Keith in the last clip. And first of all, Brett, it's great to be with you. CEOs today are navigating uncertainty. And as much as President Trump would like to, convince us all of a longer term story of strengthening the U.S. economy, in particular, strengthening U.S. manufacturing, in the short term, right, we are uncertain as to what the market is going to look like. There are certainly, calls for a recession now that there weren't maybe a month or two ago. And so I do think President Trump is trying to sell a long-term story. The rest of us are trying to stay above water in the short term.
And this also comes after we heard from Goldman Sachs CEO David Solomon this morning, reiterating this idea that CEOs do want clarity on policy from the White House and that would allow for more capital investment and more growth. I wonder then, Rob, based on your sourcing, your conversations in D.C. with folks, what might push the Trump administration to capitulate to some of these executives and provide a little bit of that clarity? Would anything?
Well, there's been a lot of conversation about where the Trump put is, right? How much pain is the Trump administration willing to take in the markets to reverse course? We're certainly not there yet, right? Maybe it's a 10 or 15% correction, and we're getting there. But honestly, I think that the more important reaction function that we have to think about in the short term is not an economic one, it's a political one. And that's Republicans in Congress going to the president and saying, listen, you don't have to run for re-election again in 4 years, but we do, right? And many of us, everybody in the House has to run again in less than 2 years. So if we're thinking about what is going to force President Trump to either reverse course on some of the tariffs that he's already implemented, although he hasn't implemented all that many so far, or at least provide some clear certainty over the medium term.
Right.
I think it's going to be that political reaction function of Speaker Johnson, Majority Leader John Thune in the Senate, saying, listen, President Trump, we understand what you're trying to do. We also want to rebuild manufacturing in the U.S., but you have to give us a chance in the midterms.
But does Trump, Trump by his own admission doesn't care what the market is doing. He's not watching it. And then even for these politicians that you mentioned, the majority of their constituents are not even invested. So is that going to actually motivate them to go to the president and try to move the needle on these policies?
Well, it's it's true that the majority of constituents aren't looking at the markets quite as closely as we are, right? But if we're thinking about agricultural states, in particular, if we're thinking about farmers, they are represented by Republicans. The middle of this country is driven by agriculture. The middle of this country also votes for Republicans. So as we're talking about reciprocal or responsive tariffs coming from the EU, coming from China, potentially coming from Canada and Mexico, I do think that even if constituents are looking at markets, they're looking at their day-to-day operations. The tariffs are something, not only are they hitting Wall Street, they're hitting Main Streets and they're hitting farmers. And so everybody's worried about the impact of these tariffs.
And so one of the other things that we kind of think back to Trump 1.0 with is the U.S. and China's negotiations that ultimately netted out a deal, but then we had COVID, so following through on some of those elements became a little bit harder, and some of the tariffs ultimately were not kind of re-engaged with by the Biden administration. So now you have a lot of companies that have tried to figure out ways just to continue to operate, either continuing to have their own agreements with China or making sure that they can circumvent any potential risk there. How is that standing right now, especially knowing the outsized risk that some U.S. companies have to their revenue if we do see a ratcheting higher of those tensions between the U.S. and China?
Yeah, so honestly, at Signum, and our coverage of tariffs is led by our head of research, Andrew Bishop. We are very rarely accused of being bullish, right? I mean, if you look at the world of geopolitical risk and uncertainty, there's certainly a lot to worry about. We're very worried about U.S., Europe in particular. Where we're not quite as worried is in U.S., China. And I say that for a couple of reasons. Obviously, we've seen, 10% tariff applied and then another 10% tariff applied, getting us to a 20% tariff increase over the course of the Trump administration so far. But what we haven't seen is significant retaliation from China. We've seen tit for tat, but nothing that sort of looks like a U.S.-China trade war in the short term. And we think that is essentially intentional, that neither President Trump nor Xi want to, go down this path of trade war, and rather both are willing to, or potentially eager to, sit down and have a discussion, right? We saw this in Trump 1.0, given the U.S.-China trade deal 1. It's true that given COVID and after Trump left office, China did not hold up their end of the bargain, especially in terms of purchasing U.S. goods. But as a matter of fact, we think Trump is eager to, get back to the negotiating table with Xi. And that's why, at least in the short term, and, rhetorically speaking, we're seeing Trump go after American allies much more significantly than he is going after China. Now, what that looks like in the long term, we think essentially it is a relatively muted trade relationship over the course of the short term, right? Not a significant trade war. And then over the course of the long term, right? The entire Trump administration, 4 years. What we think is we see very well telegraphed, choreographed and quite high phased in tariffs, but only on key sectors focused on economic security and defensive security. So, pharma, PPE, tech, semiconductors, some of the defense supplies we import from China as well. Those sectors are going to get hit hard by tariffs. But it's a story about strategic decoupling. It's not a story about broad decoupling or trade war.
All right, Rob, really great overview there. Thanks so much for making time for us this morning.
Thanks.
Coming up on the morning brief, we'll count you down to the opening bell on Wall Street, plus Intel getting a boost on reports of a potential deal in the chip space. The details for you next. Also, another analyst warning on Tesla sales. We'll break down why as shares look to rebound from the latest sell-off. All that and much more on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing tickers and stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk about shares of Intel. They are jumping right now by about 4.6% after a report from Reuters suggesting Taiwan Semiconductor approached other chip makers about a potential deal for Intel's chip foundry. Now, TSMC would hold no more than half of the joint venture, according to the report. NVIDIA, AMD, Broadcom, and Qualcomm were all approached about the potential deal, and that is moving shares of Intel higher here. This also kind of runs synonymous with TSMC and what they had pledged ultimately in terms of $100 billion in their investment into the U.S. That was made early in March, I believe. And so ultimately, as we see some of those dollars start to get put to work here, it's a question of how strategically they could bring on more fabrication processes, which is what TSMC in the wafer fabrication has largely been known for and is the essentially worldwide market leader within that effort too.
Yeah, it's really interesting to see Intel being another beneficiary of this, particularly given that we've continued to see Intel being among the better performers of the Philadelphia Semiconductor Index, though, of course, the last few days of selling have weighed on that dynamic. Having said that, I think that this makes a lot of sense for the Intel story because they have been struggling so much with their foundries. Obviously, any type of partnership with TSMC would potentially be beneficial with them. Though we should mention that the Trump administration had talked about that $100 billion investment in TSMC. So any movement from TSMC here would have to get approval from the Trump administration, though this does seem like exactly what the administration is aiming for when it comes to boosting American production and involvement in chips creation. And of course, you got Intel shares up nearly 5% off the back of this news. Well, next up, Tesla shares moving higher in pre-market trading. That comes despite a second analyst lowering delivery estimates for the automaker. In a note out today, you've got Evercore ISI lowering its price target for Tesla and their full-year estimate for vehicle deliveries. This also follows UBS lowering their full-year deliveries target as well, both anticipating Tesla delivering fewer vehicles in the current year than they did last year. So far, Tesla is the worst performing stock in the S&P 500 year to date. And you can see here on your screen the estimates for Tesla deliveries from Evercore and from UBS compared with last year. Just a slight dip compared with 2024, but still a dip nonetheless. And I think this comes amid a couple of headwinds that we've been talking about for Tesla, right? Obviously, you've got the political leanings of Elon Musk weighing on sales in Europe, but you've also got Chinese buyers switching to domestic brands amid a broader push amongst Chinese consumers to be going with China homegrown names, the likes of BYD, for example. And then you also have challenges with what they're offering, with the lack of diversified products moving forward. They haven't been offering up as much diversification as some analysts have wanted to see, and that's something else that has been a sticking point for the company. And I keep having these conversations with bullish analysts, and I keep asking them, look, if people don't want to buy Teslas, how is that not bad for Tesla's business moving forward? But the stock has performed so well, it seems like people are having trouble looking at that question.
Yeah, and Morgan Stanley, I think that is exactly where you see still some of that bullish spirit that has continued to reign through their, at least analysts here. They believe that there's still a position that is that the stock is overweight right now as of earlier this week here. And they did acknowledge within that, which was interesting, the stock down, of course, this week even further as we've been watching, the stock down 50% as of their time of writing. Their investor conversations are focused on management distraction, brand degradation, and lost auto sales. All three pillars to the downgrades that we've seen. However, it's Morgan Stanley that's saying the delivery data, even though it's been below expectations this year driven by competition, they're believing that there is still more of the opportunity and catalysts around the number of events they're paying attention to. Austin Robotaxi unveil. They're looking for some milestones around federal rulemaking for autonomous vehicle technologies. But that's a lot of things to have to get right in order for Tesla to prevail within this story right now, which has a lot of looming clouds over top of it.
A lot of uncertainty. uncertainty seems to be the theme.
Absolutely. Let's talk about this one, though. This is interesting. From Magnificent 7 to Maleficent 7. That's what Goldman Sachs is saying about those mega cap tech stocks in a note out this morning here. Goldman noting that the Mag 7 are responsible for over half of the S&P 500's move towards a near correction this week. Goldman also cutting its end-of-year target for the S&P 500 to 6,200. That is down from 6,500. There you're taking a look at some of those Magnificent 7 names' performance versus the S&P 500 and the S&P 493. So those 7 names kind of removed from it. But they've revised their base case scenario as well here, saying they're expecting a similar return from a lower level. They're lowering that 2025 year-end S&P 500 index target to 6,200 from 6,500.
The sell-off that we've seen has not been very broad-based. A lot of it has been in the large cap names. So it makes sense that they're talking about rebranding the Mag 7, not so magnificent anymore if they're not going to be responsible for the majority of the market gains. I think it's really interesting that they talk about hedge funds selling off some of their risk portfolios. That's indicative of a market that could continue to have pressure moving forward here. They also talk about the recessionary outlook. Obviously, they've increased their odds of a recession, but still not pricing in that as their base case. They do expect slower GDP growth, which of course is something that could weigh on earnings moving forward.
3 things need to happen for ultimate trough in the market to be set here. They say, first, improvement in the outlook for the U.S. economic activity due to either better growth data or change in tariff policy. Second, equity valuations, cyclicals versus defensive. Third, depressed investor positioning here.
Yeah, really important to monitor that. All right, coming up, it's the opening bell. We'll speak with Ann Walsh over at Guggenheim Partners. You won't want to miss it.
We're taking a live look at the opening bell on Wall Street and in Midtown Manhattan, where you've got great bell ringers on both sides. There, you're taking a look at some funfetti at the NASDAQ here. And then additionally, you've also got a look at FIA ringing the opening bell at the New York Stock Exchange. Looks like that's a remote bell ceremony taking place there. So not exactly at Wall Street, but still at location TBD, and looks like they're having fun, clapping and cheering. Taking a look at the major averages as we begin today's trading session. The Dow Jones Industrial Average, that begins the day higher by about 0.5%. The NASDAQ Composite, that starts off the day up by about 1.7%. And the S&P 500, that also in the green by about 1% to start off today's trading session. Of course, after we got the February Consumer Price Index data that came out this morning. Let's also take a look at some of the sector activity out of the gate here this morning. 11 sectors on the S&P 500. We got them loaded up here for you on the screen. It's some of the trades that ultimately we saw a lot of investors kind of flowing into earlier on to start the week with some of the volatility that was playing out that are actually pulling up the caboose here today. Utilities specifically and staples, those were catching a bid earlier in the week. You're now seeing those down right now to start off today's trading session. Utilities flat just barely to the downside, but staples down by about 0.9%. You're also taking a look at healthcare down by about 0.3% right now. But leading the pack, catching a little bit of a bid out of the gate this morning, you've got technology. That's up by about 2%. Going just a little bit deeper into technology, let's look at the tech-heavy NASDAQ 100 here, as you're seeing NVIDIA up starting off the day by about 5.5% in the green. You've also got some green movement here for Amazon. That is up by about 2.25%. Alphabet, Google, whatever you're calling them at home, call them higher. They're up by about 1.5%. And Meta Platforms, you're seeing that up by about 4% on a relative basis, the best performer of the Mag 7 here over the course of the year to date. We'll continue to track this, but for our deeper dive on today's early tape, let's get on over to Yahoo Finance's Jared Blickery for a look at what's moving. Hey, Jared.
Thank you, Brad. I'm going to go back to the S&P 500 and just kind of review some of the technicals here. We have S&P 500 flirting with correction territory. You need a close at or below 55.2974, so about 55.30. We just touched that level yesterday intraday, but definitely didn't close there. But my point of all of this is that last Friday, non-farm payrolls, that would have marked a good time for the market to reverse up. We've got the S&P 500 oversold now on relative strength index, and you put it all together, the market should be climbing higher right now. It's just really having a difficult time doing that. Anytime you see a rally, it tends to get sold in the middle of the day. So that's a dynamic we're working with. Want to check in briefly on the 10-year T-note yield. That is up now after reversing lower. It is up 3 basis points to 4.32%. Not going to read too much on that. We'll look at it at 3 p.m. when the bond market officially closes today. That's Eastern time. And then just a note on sector action that that Brad was going over, the mega cap sectors, XLK, Y, and C, that's consumer discretionary, communication services, and tech itself, are the leaders, while the defensive sectors, which have done well recently, those are lagging today. So a reversal of fortunes, and maybe this is the bullish impulse that we've been looking for. Highlighting Tesla real quickly, it's up 6-7% today. This would be the best day from January. You can still see that it's down 40% on the year. And I want to switch over to futures land, where I was tracking copper over the last few days, and actually over the last couple weeks intermittently. It's up 2.73% today. That is the highest level since May 2024. So we're seeing copper get into some interesting areas right now, and that's on the back of tariffs. That's not necessarily a demand picture, that's a tariff supply story. And I'll leave it with crypto here. Bitcoin, well, Bitcoin briefly touched 84,000. It is now down a little bit, but a bullish reaction, at least initially, off of Bitcoin earlier this morning, off of CPI. Maddie?
All right, Jared, thank you so much. Well, inflation pressures eased more than expected in February, calming some concern over the health of the economy that may have roiled markets over the last few weeks. Turmoil that pushed investors toward the bond market for stability. So what does today's print mean for asset allocation going forward? Joining us now, we have Ann Walsh, CIO of Guggenheim Partners Investment Management, with over $330 billion in assets under management. And also with us, Market Domination co-host Julie Hyman. Julie, take it away.
Thanks, Maddie. I want to start, Ann, and thank you for being here, by the way. It's great to see you in person. I want to start with that inflation data that we got this morning, combined with all of these concerns that we've been seeing about economic growth and the specter of stagflation that a lot of people have talked about, stagnant growth with still high or rising inflation. Does the report this morning lessen the risk of stagflation?
Well, good morning. Thanks for having me here today. So our base case, if you want to call it that, has been that we were on a glide path towards lower inflation. And as a result, lower interest rates over the course of time. That trajectory and the direction of travel continues, but the speed at which we're getting there has slowed down. And in the meantime, other narratives, in particular the uncertainty associated with some of the fiscal policies that we're hearing out of Washington, especially trade and tariff discussions, have then turned into the dominant narrative. And so as a result, what you're hearing and seeing is a change to market sentiment. And all of this is happening in real time at a pace of which we're not used to, particularly from Washington policy. It doesn't change our base case. Our base case continues to be one of a slightly slowing GDP, along with slowing global growth, and then also this glide path, if you will, towards slower means lower on inflation as well.
Nothing feels much like a glide path right now than the smoothness that implies, right? Because of all of the tariff headlines and the volatility we've seen in the markets. So your base case is for that, but I do know that your potential for a recession, the chances you're putting for a recession are higher right now than they usually are at 35%. How do you put that together, and are tariffs sort of the determining factor in that potential recession case?
So tail risk has definitely increased. And again, part of the uncertainty and the volatility. I mean, if you had to pick a few words to describe 2025, it also sort of sounds a lot like 2024, only more so. Last year, we were, of course, really worried about what was going to happen with the election. Now we had the election, now we have to worry about what's going to happen between politics and policy. And this volatility is driving, again, as I said, the narrative. The other aspect that we're also not used to is a level of transparency when it comes to the level of negotiations that we're seeing out of Washington. And frankly, sentiment's going to drag in here because between now and mid-year, when we finally actually see Congress act and potentially pass the big, beautiful bill, put that in air quotes, then we're going to see a lot of this volatility because we're waiting for Congress to act. We're hearing and seeing all these executive actions and orders, and all of this is moving the markets in real time in a way that, frankly, markets don't really like. We like certainty, and we have a lot of uncertainty. And if you think about the four major sort of pillars, if you will, of the Trump administration, which is immigration, or what I'm tending to refer to now as reverse immigration, tariffs and trade, taxes and deregulation, all of this is playing out in real time, and it's moving markets because we're trying to react to all the promulgations. And frankly, the on, then off, then on, and then off again narrative is also challenging both stocks and bonds at this point in time. And so, yes, it doesn't feel like a smooth trajectory because of all of the noise.
What would tip us into recession at this point? Would it be if we don't, for example, get the big, beautiful bill, get the tax cut extension or additional tax cuts?
Quite clearly, if we don't see the policy implementation by mid-year, that could potentially slow down the economy much more. Right now, our base case is for, we'll call it 1.8-ish on real GDP. Trendline GDP in the US is around 2%. So if we fall below that, then we get the slowing effect. And again, that's good for inflation, and we can see interest rates sort of fall relative to where we are today. By the way, we're in a trading range on the 10-year, sort of between mid-3s and mid-4s is about where we would expect ourselves to be. But if we don't see action and certainty begin to evolve in terms of policy, and then clear indications for the market, I think then what you end up with is business managers slow down CapEx purchases, they don't want to make investment decisions, and all of that then could increase the risk of that recession impulse in the economy.
I guess as a follow-up to that, if all that centripetal force is kind of around what's taking place in policy coming out of DC and waiting for that policy, then how does that impact investors feeling conviction to make a trade around a long-standing either technological shift or business trend that they can feel comfortable investing in?
Well, I think that's exactly what we're seeing right now. Measures of uncertainty, measures of market sentiment. It's the emotional reaction to what's happening in real time around us that the market's reacting to, and I think that then results in us dragging a bit more. And I had predicted this, and that's part of our base case as well. That's one of the reasons we think first quarter and into potentially early second quarter is slower relative to trend line. And then we'll have to see what happens with our friends in Washington.
How much repositioning is appropriate then, especially for a lot of the investors who I speak with are very overexposed to tech. They got in at 2020. They're used to double-digit gains. How much do they need to reposition to hedge themselves from any of the potential risks to the glide path you talk about?
Well, I think it's important for investors to think long-term and to look beyond some of the short-term volatility and noise and look to fundamentals. And the good news is that fundamentals aren't bad, and the growth opportunity and the themes still are alive and well. For example, artificial intelligence leading to productivity gains. This is a very important, very long-term trend. And you have to look beyond this sort of short-term volatility. You also have to think about the other, as I said, one of the 4 pillars of the Trump administration is deregulation. We haven't really seen that implemented yet. It's just beginning, and there's DOGE, and there's a lot of other noise within the Trump administration right now. But again, those long-term tailwinds are still alive and well, and we still need to think about them as long-term investors. So I tend to say, don't overreact. Think about what the impact is going to be. Also, other areas, manufacturing build-out, power, infrastructure, all of these trends in terms of the global changes that are happening, the reshoring into the U.S., all of this is a part of the long term. Think longer term.
Finally, I want to ask you a question away from the markets and about Guggenheim specifically. So you are Chief Investment Officer. The president of the firm, Dina DiLorenzo, another woman. I think about a third of the firm is women. We are in a period of time right now where there's this backlash against DEI and efforts to create a more diverse workforce. How are you guys thinking about this now at Guggenheim? Are you changing anything?
Well, we're certainly not changing anything because we think we're extremely well positioned. We've always had the viewpoint, because we have a very unique investment management process, which is team-based and collaborative, that multiple voices, differentiated voices, come together and develop better outcomes in terms of performance. And we've proven that year in and year out for the past nearly 2 decades that I've been with the firm, and has Dina. And so as a result, we're not changing anything. We're going to continue on exactly the way we think about developing our investment process and our excellence for our clients. And that means lots of interesting and different opinions coming together.
Well, it's been successful, and we've certainly been tracking it for years now. Thank you so much for taking the time here with us in studio. Great to see you, Ann.
Thank you so much.
Julie, thanks so much.
Sure.
Coming up, everyone, a look at the impact rising recession concerns are having on treasuries. That's next on Morning Brief.
Take a look at the bond market here. You've got yields moving to the upside off the back of that better than expected CPI print, showing inflation perhaps decelerating ever so slightly here. You've got your 10-year yield now around 4.3%, up a few basis points from earlier in the week when we were hovering around 4.2. Now, today's action coming as bond traders increasingly signaling concerns of a potential recession. Here to discuss more with us, we've got Tom Porcelli. He's PGIM's fixed income chief U.S. economist. Tom, great to have you as always. What is the bond market telling you today? What are we expecting in terms of the Federal Reserve? And what does that tell us about the market as well?
Yeah, so good to be with you as always also. When I look at the market, I think the market is sort of conflicted here a little bit, right? You have to consider two important things from this CPI report that just came out a little while ago. One, it was better than expected, but this doesn't reflect tariffs, right? This is a reflection of what was. It's not a reflection of what is to come.
Right.
And so I think that's sort of tempering the market's reaction, which is why yields are up. I think the other thing you need to keep in mind too is that when it comes to CPI, really what we need are sort of the components within CPI that feed into PCE. And so when we look at those components that feed into PCE, it looks like PCE could actually be pretty firm. We're looking at about 0.3 right now. We'll firm that up after we get PPI tomorrow. So I think both of those factors, the reality of this report does not reflect tariffs, and it looks like PCE is going to be a little firm is what's driving yields higher.
So what end of duration, just to kind of get that question out the way, what end of duration should investors feel comfortable with at this juncture?
Well, when you say end of duration, you mean like sort of where across the curve should people feel comfortable?
Certainly.
Yeah. So, look, I would say it this way. If I look at like 2s and 10s, I think, 2s as always are going to be at the mercy of what's going to happen from a monetary policy perspective. Our view is that you're likely going to see cuts this year. I mean, we've had 2 cuts built in for this year since the beginning of the year, actually since late last year. And that's something we still expect. I think 10-year yields will probably be a bit more anchored. But again, I just want to be clear on this point. That assumes that we actually don't see the worst of tariffs. At the end of the day, wherever you're going to be across the curve is going to be, at the mercy of what degree of tariffs do we see? Because I can make an argument if we do see some pretty aggressive tariffs that I actually think that would usher in a more aggressive easing cycle for the Fed. Everyone's talking about this impact on inflation, and I have a ton of sympathy for it. I mean, I think it will show up in inflation at first, but I think ultimately this will actually wind up biting growth. And so I can make an argument for the Fed to ease even more, in which case that's not priced into the market.
So do you think that there is evidence then, Tom, to support the idea that the Trump administration is okay with what they've said, causing a bit of pain, because then the Federal Reserve will have to cut and then that'll be a lift to the market?
Yeah, it's interesting. We were talking about this yesterday. I mean, people keep on wondering, what's the pressure point for the administration? I think everyone has been assuming it's the equity market. I don't know. I mean, I keep on hearing them talk about 10-year yields. And, the only way to bring down yields really in a sort of a practical sense in the near term is through the monetary policy channel. And so if all of a sudden things do weaken on the back of tariffs, it would usher in a more aggressive easing cycle, which again is not built into the market,
right.
Which is what you would get is how you would get a sort of a bigger market reaction in yields.
But isn't a recession also a way to get the 10-year lower?
Yeah, definitely. And just to be clear, that's exactly right. So you usher in a more aggressive easing cycle if tariffs do go through in earnest, because again, I think that's going to show up from a growth perspective more than I think from an inflation perspective. Yeah. And that's the magic, right? That's how you get yields lower. I don't know if that's necessarily what we should be cheering for. When you have a recession, it comes with job losses. That's the reality of recession.
And so if we did see a recession that fades, and that it's already started to fade, the U.S. exceptionalism trade, how has that started to get factored into what your team is kind of laying out in its own forecasts?
Yeah, it's an important idea, and this is something that we've been trying to drive home for the last several quarters. we think the left tail. So the left tail, from a probabilistic perspective, the left tail is sort of the downside risk. And so we've been saying that the left tail is pretty fat because of all these risks on the horizon. So we definitely have a skew to the left as it relates to the backdrop. Again, we think that the backdrop, if you just took a snapshot in time today, the backdrop is actually moving along at a pretty good pace. It's just that we have now all of the uncertainty associated with tariffs that is really, we think, going to weigh on economic activity and makes that left tail just a little fatter.
All right, Tom, we got to leave it there. Thank you so much for joining us. Appreciate it.
Thank you.
Well, coming up here, we are going to continue to talk about what's going on in the market. Stick with us.
We're taking a closer look at some trending tickers that have been outperforming as of late, defying the broad reversal of the Trump trade here. And the stocks are Supermicro Computer, Palantir, and Netflix, all for different reasons. First up, Supermicro, that's up 47% since the election here. There you're taking a look at shares. And of course, there was a lot to keep tabs on within this embattled name, which, if you recall, of course, had a lot of the investor attention really called forth during some of the allegations that came forward in the short seller report last year. However, it is outlasting the reversal of the Trump trade, as it was the criteria for making it into our trending tickers for this hour.
Yeah, the theme between all three of these stocks is that there's something fundamental to each individual company that is allowing them to outpace the broader market. So for SMCI, it's their return to being listed. It's the fact that they have eased investor concerns about their accounting issues, and they've
check the financial boxes.
Check the financial boxes. But the next company we want to talk about, Palantir, up nearly 53% year to date. Also, stock soaring off the back of this 15-second teaser clip that Palantir executives posted online over the course of the last 24 hours here. The company taking stage at AIPCon, and is that going to be some announcement that leads to a bigger lift in the stock? But again, investors believing in the defense play with Palantir. That's what's specific to that stock, beating the Trump trough here.
Yeah, and just to clarify, just since the election, it's up 54% here. Year to date, I think it's up somewhere around 8%, but a lot of that, it really was kind of the drawdown that we've seen in the broader markets as well. And some of the valuation tests that companies, especially with that of Palantir, that was carrying a massive PE ratio. Even today, I think the PE ratio still sits somewhere around 435 at this point. So there is a lot of expectation that is baked in that is still yet to be delivered upon on an earnings basis for the company, despite some of what they're announcing here today as well. Also, let's go to your streaming habits, everyone. Netflix is up 17%, and we're taking a look at shares, and it's 17% since the election. Of course, during this period, it's important to watch how many of the services consumers are continuing to buy into, spend more, especially across some of the price increases that have come forward in the direct-to-consumer entertainment landscape.
Yeah, and that's despite the fact that they've had a challenging month over the course of March. But that's going to do it for Morning Brief. Joining me next for more on Catalyst. Stick around.